Good morning, and welcome to Understanding Forgiveness Requirements as the SBA Interprets the Rules. My name is Dana O'Donnell, Director of Marketing with Schaeferman-Laken. Attorney Scott Borsak, who is a partner and chair of the Schaeferman-Laken Business Department, will be presenting today's program. Before we get started, I want to let everyone know that today's webinar is being recorded and will be emailed to you tomorrow. It will also be available on our website, www.schaeferman.com. Should you want a copy of the presentation slides, you can download from the Handouts tab. Scott will be taking questions at the end of the presentation, so please submit your questions on the Questions tab, and we will try to get to as many as possible. Let's get started. Scott?
Thank you, Dana, and good morning, everyone. Welcome to another installment of As the SBA Turns. And turns is a good reference because while most of us were getting ready for the long Memorial Day weekend, the SBA was busy at work and was putting out more interim final guidance for us to consider. So as we've done in the last couple of programs, you'll notice the slide deck has a number of items that are underlined, and those underlinings are there to signify new materials that have been added by the SBA. I also want to mention that we're working on a program that's just dedicated to the forgiveness application, and we will probably be rolling that out the second week in June, and we'll be advertising that shortly so you can sign up for those programs as well. But today we have kind of a deep dive into forgiveness generally and some of the things that the SBA has been working on. So of course we are talking about the Paycheck Protection Program, which is part of the CARES Act. The PPP created a loan program, loan to grant program, which allows for loans of $10 million, which can be forgiven if the proceeds are spent on eligible expenses. Repayments of these loans are due within 2 years from the date the loan funds, with interest at 1%, and borrowers are given a 6-month payment holiday. As I mentioned from the outset, the SBA has taken a guidance-as-you-go approach here. The statute came out in short order, and the SBA really has been playing catch-up, relying on practitioners, attorneys, accountants, and borrowers who have commented extensively on the statute, some of the earlier guidance, and guidance as it's released. And as a result, this becomes an ever-changing environment that we have to be aware of and follow. There was quite a bit of consternation, both in the media, in the general public, amongst the number of borrowers and those who applied but were never approved, around this question of financial necessity. And what the SBA told us was that they in Treasury believe that too many big borrowers got loans, borrowers that really did not need these loans because they had sufficient financial resources, they were publicly traded companies, or otherwise had the ability to ride out some part of this storm represented by the pandemic. And through that period of the middle of this month, May 14th to May 18th, the SBA did come out with some guidance here and told us that loans under $2 million are going to be presumed to be necessary for the borrowers to deal with the uncertainties created by the pandemic. Those borrowers that have affiliates who have loans, the affiliate loans will be aggregated with the borrower to determine whether they're under this $2 million line. It's possible that when aggregated with other loans, a borrower could be kicked over that line. The SBA did not provide us any guidance on what constitutes necessity, which I have to say was disappointing. But what they did tell us was that if they determine a loan wasn't necessary, so long as the loan is timely repaid, there will not be any prosecution for false certification of necessity on the application. So regardless of where they come out in guidance, the worst case scenario a borrower is facing is a deeply discounted loan that has to be paid in 2 years. Hopefully, there aren't very many borrowers who find themselves on the wrong side of this certification question. We have 4 inquiries that affect forgiveness, and we'll be focusing on them throughout this morning's program. We talk about a reduction in headcount, comparing the number of full-time equivalents after the loan is made to the full-time equivalents prior to the loan being made. We look at reductions in individual salaries during the 8-week covered period once the loan funds, as compared to the first quarter of 2020. We look at the expenditures that borrowers make of these funds, and we're only allowed to use PPP funds if we want to apply for forgiveness for payroll expenses, utilities, rent, and business mortgage interest. And then there are 2 applicable periods that we're allowed to spend, one of which gets us forgiveness, and one which gets us a discounted loan. The statute allows spending from the period of February 15th to June 30, 2020. So June 30 is one date that we're concerned about, but we only get forgiveness as the law presently stands on what we spend in the 8-week period that begins when the loan originates. So 2 periods to deal with, although as you'll see later on in the program, that June 30 date may not necessarily be a June 30 hard date. The SBA has suggested that in any conflicts between the covered period and June 30, that the covered period may take priority. And I say this is a suggestion because so much of what the SBA has done here isn't explicitly stated. There was 2 examples in the guidance that was released on Friday night that has the covered period extending into July. And the only way we could get a covered period in July and a borrower eligible to spend money in July is if the covered period takes precedence over the June 30 date. The other thing that I'll tell you is that there is legislation pending in Congress. The House of Representatives barely passed what's called the HEROES Act. And in the HEROES Act, the June 30 date was extended to December 31st. Now, there's a lot in the HEROES Act. It's unclear at this point what the future of the HEROES Act is in the Senate or at the other end of Pennsylvania Avenue. There's discussions about the Senate taking up a separate bill that will do one thing, which is to extend the June 30 date to December 31 of 2020. That legislation hasn't been introduced yet, and the majority leader in the Senate, Mitch McConnell, said yesterday that there's going to be a further relief package in about a month or so that's going to start in the Senate. Obviously, that won't come fast enough for the June 30, so our best hope of getting some extension on this date is this standalone bill if it's ever advanced. But until there is legislation signed, I think borrowers need to keep that June 30 date in mind because for most of you, it's going to provide a significant deadline that has to be complied with. So let's start with the workforce headcount and talk about what we're specifically looking for here. We're talking about full-time equivalents, FTEs, And the SBA recently told us that notwithstanding all of its other guidance in other legislation, which suggested FTEs work 30 hours, for purposes of PPP, an FTE works 40 hours. So forget everything I told you about 30 hours in the past. FTEs work 40 hours a week or more. So one FTE is someone who works 40 hours, and we can have 2 or more part-timers that together aggregate 40 or more hours, and they would count as one FTE. But we'll also talk about an alternative means of computing FTEs in a moment. So we have to determine the average number of FTEs employed prior to the loan. And here, employers and borrowers get the opportunity to pick a period. You can either pick the period from February 15th, 2019 to June 30, 2019, or you can pick the period January 1, 2020 to February 29, 2020. I'll mention here briefly that seasonal employers have the opportunity to pick a 12-week period outside of these two ranges to cover their particular seasonality. And for most, that's going to be the summer for those who in this area who have summer businesses. And we're just about finished with a piece that we will be posting on the website with a couple of the ins and outs of the program for seasonal borrowers, and we're going to try to get that out in the next couple of days. So you're going to look at these two periods, and you're going to choose the period that has the fewest number of FTEs, because this is the test period. This is what we're looking to at least match during the covered period. So by picking the test period with the lowest number of FTEs, we're helping to set the bar lower so that it's easier for us to achieve when we're testing our covered period. So we pick our period, determine the average number of FTEs, and then we're going to compute the number of FTEs employed during the 8-week covered period, which begins when the loan funds. We're going to look at all employees on the payroll during the affected periods. So our test period as well as the covered period. Some of the tests we talk about here exclude employees by amounts paid. The FTE test does not. Everybody counts. The only question is whether they count as a full-time or a part-time. So determine the average number of FTEs per month. One period is, one of the test periods is 2 months. Another is 4.5 months. This may lead to some awkward computations, but we're trying to determine the average number of FTEs in this period, so we should be able to smooth that over with averaging. Ultimately, we're going to look at pay periods in a month. So if your pay period is weekly, your FTEs, as we talked about, work 40 hours a week. Bi-weekly is 80 hours in the pay period, and semi-monthly, those are usually the 15th and the last day of the month. Semi-monthly is 87 hours per pay period. There is a penalty here for a bad action, and here the bad action is not having enough FTEs in the covered period. That penalty results in a reduction in the amount of forgiveness that a borrower is eligible for. The percentage reduction in forgiveness matches the percentage reduction in headcount. So if we experience a 20% reduction in headcount in the covered period, 20% of your eligible spend is not going to be eligible for forgiveness. You do have the opportunity to fix these bad actions so long as the actions occurred within a certain time frame. You get the opportunity anytime on or before June 30 to hire back enough FTEs so that your covered period FTE matches what you had employed on February 15th. The way we compute this penalty, we're going to determine a reduction fraction, and that is the number of FTEs that we have after the loan divided by the number of FTEs in our test period. The reduction fraction is multiplied by the eligible spending, and that gives us the dollar amount that is no longer eligible for forgiveness. Now, the FTE penalty is applied to the exclusion of salary reduction where both exist. So what do I mean by this? In a number of situations where you have fewer FTEs in the covered period than you do in the test period, technically, in addition to having fewer FTEs, you also have salary reduction. By that, I mean, if we have employees A, B, and C in the first quarter of 2020, and in the covered period, we have employees B and C, we have one less employee in the covered period than we did in our test period. And that one employee who's missing also didn't get paid a salary. And as we talk in the salary reduction test, you'll see getting paid less than you did in the first quarter also can affect forgiveness. What the SBA has told us as recently as this past Friday is that where you have a salary reduction and a loss in headcount as to the same group of employees, you only apply the FTE penalty to that group of employees. You don't also apply the salary reduction test. So instead of there being two penalties where they applied, the SBA has said we apply one, and the one we apply is the FTE or workforce headcount penalty. The SBA has also given us an alternative means to determine the number of FTEs. First, kind of a straightforward way of doing it, you look at the average employee hours worked in a week, divide by 40, round to the nearest 1/10, capped at 1. So somebody who worked 50 hours, for example, if you divide by 40, you would come out with 1.25, but you can't be more than one full-time equivalent, no matter how many hours you work. So that 50-hour person would be capped at 1 and count as 1 FTE. You do the same calculation for a part-timer. Someone who worked 10 hours, you'd get 0.25, rounded to the nearest 10th would be 0.3. So the alternate calculation that the SBA has suggested is that we assign the number 1 to each employee who works 40 or more hours, and assign 0.5 to each employee who works less than 40 hours. So this is an easier way of determining FTEs. All of your part-timers count as half. So 2 part-timers, regardless of how many hours they worked, would equate to 1 FTE. So this might be an easier way to determine how many FTEs you have on both sides. I suggested that there is a fix here where you can go back and correct for errors. I've referred to it as a mulligan. Those golfers out there might appreciate the reference. So the question here in making this determination is whether or not you had a reduction in force from February 15th to April 26th. If you cut your workforce after April 26th, you can't fix it for purposes of the headcount test, at least under present law. You can undo the reduction in force and ignore those changes by hiring some portion of the laid off employees. If you bring back those laid off employees on or before June 30, you're fine. You'll be deemed to have satisfied the workforce headcount test for the entire covered period, even though you bring them back late in the period or on June 30. Question is how many to rehire. So you have a reduction in force from February 20th to April 26th. What the law allows you to do in applying this mulligan is to hire to the average number of FTEs that you had on February 15th. I know February 15th, 2020 is a Saturday. You still had payroll and you still had employees on the Friday before, and we'll still have them on the Monday after. So whatever the number of FTEs you had on February 15th, that's your target number to go hire back to. Now that could be lower than the pre-loan period. It will probably allow you to hire back fewer employees than you actually laid off. But if you bring your number in the covered period up to the February 15th level, then your reduction in full-time equivalents is ignored. You still need to pay these people because even though you've brought them back and you've eliminated the reduction in force, those people who were paid in the first quarter still need to get paid during the covered period. If not, you've got a salary reduction issue, and we're going to talk about the salary reduction test next. Just remember where both an FTE penalty and a salary reduction penalty may apply. The FTE reduction is the one that we're going to be concerned about. So there's not any double dipping here of penalties anymore. The SBA has clarified that for us. Where we have an uncorrected reduction in force that violates the workforce headcount test, the only thing we're going to penalize a borrower for is the reduction in headcount. So simple example, we have 8 FTEs before the loan, 6 FTEs after during the covered period, and 7 FTEs on February 15th. This yields 6/8 or 75% of the workforce. We have 2 fewer FTEs in the covered period. Only 75% of eligible spend can be forgiven because we had a 25% reduction in headcount. So 25% of the loan has to be repaid. Our remedy here, though, is to hire 1 employee back by June 30 because we had 7 FTEs on February 15th, which is our mulligan date. We had 6 FTEs in the post-loan period, the 8-week covered period after the loan funds. So that means that our target to avoid the headcount penalty is a rehire of 1. And so long as we do that by June 30, we don't have a penalty for an FTE reduction. And as I've pointed out so many times, even though we've gotten an exception from the reduction in force, we still have to spend dollars to make up the salary deficit. Payroll reductions. What are we looking at here? We're looking at the salary of each employee who is paid no more than $100,000. Now, this part of the test is different than the FTE test because if you remember in the FTE test, we considered all employees. We made determinations based on whether they were full-time or part-time, but everybody was considered in the analysis. In the payroll reduction test, the only employees that we're looking at are ones who were paid no more than $100,000. We're looking at those employees who were employed in the calendar quarter before the loan originates. So for everyone who's listening, who's companies have gotten a loan or they've gotten a loan individually, the full calendar quarter before the loan originates is going to be the first quarter of 2020. So what we do is we're going to look at that first quarter and then find those employees in the covered period. We're going to look at the salary of each employee in the 8-week period after the loan originated. And any employee who was not employed in that first full calendar quarter also doesn't get tested. So there were some employees who may have worked in 2019, didn't work in the first quarter of the year, came back at some point after the loan originated or immediately before. But the period of time that we're testing for is the first quarter. So only those employees who've gotten compensation in the first quarter are going to be tested. What the law requires is that each of those Q1 employees must be paid at least 75% of what they would have been paid in the covered period when you compare them to the rate they were paid in the first quarter. This is a specific test to each employee. It's not enough to look at your gross total payroll and test that during the covered period and compare that to the first quarter. And the application for forgiveness does get that granular. It does track the statute where the statute looks for, talks about specific employees. The application also drills down employee by employee. So this is a specific test. Unlike the FTE test, where new hires might make a difference, under the payroll reduction, new hire doesn't make a difference. Using my earlier example with employees A, B, and C, if I fire A, B, and C and hire D, E, and F in the covered period, I've taken care of my headcount, but none of D, E, and F have any salary. So because they weren't paid, 75% of what they should have been paid is going to serve as a reduction in the amount of my spending that's eligible for forgiveness. So here in the payroll reduction test, new hires don't help us as they do in the FTE test. So what we're doing here is a comparison of payroll. We're looking at the 13 weeks of the full calendar quarter immediately prior to the loan, also known as the first quarter of 2020, and we're comparing that to the 8 weeks following loan origination. So we're left with comparing 8 weeks of compensation to 13 weeks of compensation. Well, obviously what we have to do is determine an average pay period payroll in Q1 for each employee. When we come up with that average, we know that's what the employee should have been paid in each pay period during the covered period. So we need to compare the average in Q1 to what the employee is paid in the covered period and determine if there's a reduction. Individual employee payroll has to be at least 75% of what it would have been using the Q1 rate. If we don't hit 75%, there's going to be a reduction in the amount of borrowing that is eligible for forgiveness. And as I say, we're actually going to look at each individual employee's payroll experience and the amount by which their covered period payroll doesn't make the 75% line. There's a deficiency in their compensation. That deficiency on a dollar-for-dollar basis is going to reduce the amount of spending that is otherwise eligible for forgiveness. And here we have a third bite at the apple, another correction, another mulligan. An employee who's had a salary reduction from February 15th to April 26th can be restored to the rate of pay the employee received on February 15th of 2020, it's not enough to eliminate the reduction in pay rate, but we have to eliminate the reduction in compensation actually paid. So, if an employee was getting $25 an hour in Q1 and started getting only $20 an hour in the covered period, it's not enough to increase them to $25 if, as a result of that reduction, they weren't paid 75% of what they would have received under their full rate. We have to pay them back pay to get them to 75%, because by not doing so, we have a deficiency that will impact the amount of spending that's eligible for forgiveness. Just as we saw with the FTE test, this mulligan will only correct reductions in salary that are made before April 26th. After April 26th, if we reduce the salary, there's no fixing it. We have to make this fix by June 30. And if we make the fix and we pay the employees the back compensation, then our forgiveness is not going to be subject to reduction on account of payroll reduction. And as I pointed out a couple times, you actually have to spend this money. You have to spend the payroll dollars. It's not enough to bring them up to the rate. You've got to correct the deficiency. As I noted with the FTE test, where I have an employee who is both eliminated and therefore has a salary reduction issue, I'm only going to penalize the employer for the FTE reduction. The SBA now tells us both penalties do not apply where they're both available. It's just the FTE test, and the salary reduction for an eliminated employee isn't considered. Now, the SBA has also given us some more helpful guidance, and they've told us that an employee who retires, voluntarily resigns, is fired for cause, or voluntarily requests to have their hours reduced, they're not considered in the mix for either the FTE or salary reduction tests. I've gotten a lot of questions about these circumstances, over the last 4 weeks, and we thought it made sense that an employee who voluntarily separates should not result in a penalty to the employer. The SBA has finally stated what some said was the obvious, that these group of employees who leave on their own accord or voluntarily request to reduce hours will not have an adverse impact on the forgiveness determination. They're considered as though they weren't employed at all, either during Q1, during the pre-loan testing periods, or during the covered period. Now, the SBA has also told us that an employee on unemployment who refuses to return to work after being called back can also be ignored. And the SBA first gave us 4 points that we needed to consider, and then Friday added a 5th point, which, when I tell you about this, I'm sure will make your day. So what the employer has to do is offer their employee the job that they had at the same hours and same compensation as before termination. The offer has to be made in writing, which advises the employee that their failure to return to work could jeopardize state unemployment eligibility. The borrower has to inform State Department of Labor that the employee rejected the offer within 30 days of the date of the notice. And this is the new point here. So it's not enough to make the offer. It's not enough to tell the employee if they fail to accept the offer that they could jeopardize their eligibility. Now the employer also has to inform Department of Labor that this was the choice of their employee, and this has to be done timely, within 30 days of the date of the notice. I know a number of employers had difficulty in even sending out this kind of notice. I think this is going to be that much harder for some employers to actually inform, excuse me, actually inform the Department of Labor that the employer rejected the offer, and potentially making matters worse for an employee. But this last point about informing DOL is a new requirement. So these employees who refuse to come back from unemployment, where the employer follows this recipe, will also be excluded from the FTE and salary reduction tests. Let's look at an example. An employee paid $3,000 each period before a loan and $2,000 each pay period after. The length of a pay period semi-monthly. The average salary rate before, $3,000 per pay period, or $18,000 over 12 weeks, $12,000 over 8 weeks. Average salary rate after is $2,000 per pay period, or $8,000 over 8 weeks. So the employee had a $4,000 salary reduction. Math is pretty simple. That's a 67% reduction. So potential forgiveness reduction of $1,000, 75% of the $12,000 that they got in a pay period prior is $9,000. They were paid $8,000, so that gives us a $1,000 deficiency. The options here: restore the salary deficit by June 30 to the prior rate. We still have to spend money in the particular time frames, and we have to get the employee back the $1,000 to get the payroll up to 67%. So we've been talking a lot about the Mulligans rehiring a certain number of FTEs to get us to the February 15th number, and making corrections in salary rates and paying back salary. So some have asked the question about an employer who has a reduction in force and reduces salary, but fixes one of these failures, but not the other. And is that employer still subject to penalty? Well, we now know for certain that you're only subject to one penalty. It's the FTE penalty. So the employer is excused if the headcount is restored to February 15th level. The salary reduction is excused if we go back to the February 15th rate and we pay the deficiency to get to 75%. So if we fix them both, obviously there's no particular problem. If we fix one, we still have a penalty to contend with, because the Act looks to where we have an FTE reduction that's corrected, a salary reduction that's corrected, or we correct both. We know that if you have both and you make no corrections, you're only going to be faced with the FTE penalty. If you fix the FTE penalty, but you leave the salary reduction, you still have a salary reduction issue. And if you fix the salary reduction, but don't fix the FTE, you still have an FTE issue, and you can't completely satisfy the salary reduction test if you don't bring back all of your FTEs. Where both exist and neither is fixed, only the FTE is going to apply. Where both exist and you only fixed one, the other is going to apply. Permitted expenditures. Loan proceeds must be spent on allowed expenses, payroll, rent, utility, mortgage interest on business-owned property. Amounts must be both incurred and paid. The statute uses incurred and paid, and most of the guidance has used incurred and paid, but now we're starting to see some softening of this for administrative convenience, and we'll talk about some of that in a moment. So how do we prove that we've paid amounts? Obviously, that's going to be by canceled checks and invoices. Determination of what incurred means. For many individuals, expenses they are incurred when they actually pay them. Something like payroll is obviously incurred as an employee is providing services to the employer. We generally can't pay expenses ahead. We can't make prepayments and still hope to get forgiveness. We have to be making payments where our obligation to make these payments is fixed and due. And generally, we need to satisfy these both. But as you'll see, there is some softening here for billing periods that straddle the beginning of the covered period or the end of the covered period, allowing for some administrative convenience here, but also acknowledging yet another test, which we'll talk about near the end of the program, the 75-25 test. Payroll expenses include employee compensation that is salary, wage, commission, that's not in excess of $100,000 a year. So in the 8-week covered period, that would be $15,385, which is 100,000 divided by 52 times 8. It can include cash, tips, or the equivalent, pay for vacation, parental leave, medical, sick, or family leave, including amounts that we have paid to furloughed employees. So there's been a lot of discussion amongst borrowers. I have no work for my employees. The only way I'm going to get forgiveness is if I pay them. Well, on what basis am I going to pay them? And we've advised borrowers who've asked that question, it's vacation time, it's paid leave. And now the SBA in recent guidance has suggested amounts paid to furloughed employees is also treated as compensation. So, we were spot on with this advice, and employers can continue to do that. Allowances paid for separation or dismissal in the nature of severance are also good spends for payroll costs. The employer cost for group health care benefits, including insurance premiums, also eligible for forgiveness. The employer costs for retirement benefits are eligible for forgiveness. And as to those last two categories, because employee compensation goes in at gross, and those items are subtracted from the gross compensation that the employee is due, we don't consider the employee side of those expenses because effectively it's already in there. It's part of the gross compensation. The state and local employment taxes assessed on compensation, which are paid by the employer only, are also included as permitted expenditures. For a borrower who's an independent contractor or a sole proprietor, compensation due the independent contractor or sole proprietor that shows up on their Schedule C each year is eligible for forgiveness. As we'll talk about in a couple of minutes, the amount of compensation that these borrowers can take is limited. Now, don't confuse this with what a borrower can do for their independent contractors. A borrower who pays an independent contractor cannot claim credit for the amount that the borrower gives to the independent contractor the same way as the borrower pays its employees. The independent contractor is a separate entity entitled to borrow their own, make their own application for PPP and pay themselves separately. This would be tantamount to double dipping, and a borrower cannot include amounts paid to an independent contractor as compensation. Amounts paid to a partner in an entity taxed as a partnership that is generally subject to self-employment tax is also eligible for treatment here. Again, limited to $15,385. So here's some more detail on sole proprietors and employee owners. Their compensation is going to be limited. No more than 8/52 of the 2019 salary and net income of the sole proprietor or employee owner up to $15,385 is eligible for consideration as part of wages paid to employees. The employer costs for retirement and health care of an employee owner are eligible for forgiveness. And this is different than the rule for sole proprietors. Sole proprietors are those who are reporting income on Schedule C of their federal Form 1040 cannot be forgiven for retirement and health care cost spending, only for amounts attributable to the sole proprietor. So if you're a sole proprietor and you have employees, you can properly spend on retirement and health care for your employees, just you can't claim forgiveness for yourself for those expenditures. That's different than the rules for employer owners, shareholders in a corporation, and members in a limited liability company, where retirement and health care of the employee owner is eligible for forgiveness. And we've said this a couple of times, the limit on payroll per employee is $15,385 during the covered period. There's no apparent limit on the other costs, those being for health insurance, retirement, state and local employment taxes that the employer has to pay. We've already mentioned this point earlier, but it does bear repeating. An employer borrower cannot pay an independent contractor with PPP proceeds and claim that spending as eligible for forgiveness. Another important point that we got from recent guidance, hazard pay or bonuses paid to employees during the covered period are going to be treated just like any other compensation. I know that was a question, and I heard some anecdotes of professionals reaching out to the SBA and speaking to folks in regional offices and being told that hazard pay or bonuses were not going to be permissible. Well, the official word from the SBA is they are permissible, and again, subject to the same limit of $15,385 per employee. Payroll doesn't include compensation paid to employees outside of the US. So if the borrower has employees outside the US, we can't claim forgiveness on the amount of compensation paid to those individuals. We're not going to get credit for federal employment related taxes that the employer pays. And we're also not going to get credit for sick leave and family leave wages for which the employer qualifies for a credit under the Families First Coronavirus Response Act, what's called an employee retention tax credit, where the employer gets 50% of the amount spent on those wages, up to $10,000, as a credit against other taxes. And here's something that's going to be particularly helpful for those payrolls that straddle the covered period. Borrowers with biweekly payroll or more frequent can elect an 8-week covered period that starts on the first day of a pay period after the loan funds and ends 8 weeks later. So if a loan funded on April 5th, but the next payroll cycle begins on April 10th, you can push the 8-week covered period to April 10th. And the advantage of doing that is that your covered period more closely links up with your payroll cycles. You would have what's called an alternative payroll covered period. The payroll costs are going to be determined with reference to the alternative payroll covered period. Borrower costs incurred in the last alternative payroll covered period on or before the next payroll are eligible for forgiveness. So long as that payroll is actually paid on time, that portion of the wages that accrued during the covered period are going to be eligible for forgiveness even though they were paid outside of the covered period. So the alternative covered period probably eliminates the need to run a special payroll on the last day of the covered period. Now, if we're using the alternative payroll covered period, then we're going to run the salary reduction and FTE tests under that same period instead of the standard 8-week period that begins when the loan disperses. Another new provision: expenses paid during the covered period or billed immediately after the covered period and paid on or before the due date once the covered period ends are going to be eligible. So forgiveness for expenses paid prior to the covered period but paid in the covered period are now considered eligible. There was an example in the materials released by the SBA on Friday that had a utility bill scenario where the covered period started. A day later, the borrower paid their utility bill, which clearly covered a period of time prior to the start of the covered period. But in answering the example, the SBA said the employer gets credit for that payment, that first payment made early in the covered period, as well as the second utility bill and a portion of the third monthly bill, but only for that period of time within the covered period. So you'd have to do an allocation on that last bill. Now that clearly is going to get more than 2 months worth of utility payments into the analysis. The SBA's rationale here is that because they're going to place a limit on non-payroll expenditures to 25% of the total spend, they feel that's more than adequate to limit the potential excesses of allowing a liberalized approach to when expenses are incurred during the covered period. So we can technically get more than 2 months of some of these expenditures in. But again, the limit's going to be 25%. We'll talk about the 75-25 in just a couple of minutes. You're also entitled to take mortgage interest, but not the principal. These are going to be on obligations that are secured by business property. You can't prepay any of this. Generally going to get 2 months, although under the treatment of the mortgage interest, I'm sorry, under the utilities example, it's possible you might get 2.5 months of this. You can get rent under leases that were in place before February 15th, and that includes equipment leases, cars and trucks as well. Utility charges, telephone, internet, electric, water, sewer, transportation. Included within that are fuel costs to operate vehicles. And I'm wondering if we're getting fuel costs, how far away could toll charges be? Timeframes. Borrower has 8 weeks from the time the loan is funded to spend proceeds on qualified expenses. Now, for those borrowers whose covered periods end before June 30th, seems to me the statute's pretty clear. Funds have to be expended by June 30 or they have to be returned. There's nothing about this program that seems to be a loan in the traditional sense. It's a loan if you spend the money on things you're allowed to spend it on. And if your covered period ends before June 30th, all you can do is spend money on allowed expenses and get a 1% loan on the amounts you expend that aren't subject to forgiveness. Now, the SBA has suggested for those people whose loans have a covered period that would extend beyond June 30, that it's the covered period that takes precedence over the June 30th date. And who are those people who have loans the covered period extends beyond June 30? The ones whose loans funded on May 6th or thereafter. Now, the SBA didn't come out and say this explicitly. They said this in an example in guidance that had covered periods that extended well into July, and in one case, in August. So what I take from this is that they may be telling us that where the 8-week covered period conflicts with the June 30 date, the 8-week period is what we look at. But this is all reading between the lines. It would be much easier if the SBA just came out and said, if there's a conflict, the 8-week covered period governs. But at least we've gotten a suggestion here that the 8-week covered period is the line we're looking at. So where the loans funded on May 5th or after, the only thing that the most borrowers are really going to be concerned about is the 8-week covered period. They need to spend their money in those 8 weeks, and unless the June 30 date is extended, once they get to the end of their 8 weeks, they can't spend money on anything, and they need to repay any proceeds that remain. Those whose loans funded earlier had the opportunity to spend money on expenses outside the covered period, the expenses falling within the list of things we talked about, payroll, utilities, mortgage interest, and not get forgiveness, but just have to repay them. And the difference between repaying and forgiveness is we only get forgiveness on what we spend during the covered period. We can treat as a loan amounts we spend on eligible expenses outside the covered period, but before June 30. But that's only an issue for people whose loans funded prior to May 5th. Requests for forgiveness. These are all going to be made by the borrower to the lender. We're probably going to see that in some web-based utility. The SBA sanction form was released, and it is a little complex. The SBA is going to ask us for proof of FTEs and payroll costs for the pre-loan and post-loan periods. They're going to want us to submit payroll filings to tax authorities and to deliver to them the payroll statements from our third-party payroll providers. They're going to want proof of payment of eligible expenses by canceled checks, bank statements, lease statements, and utility bills. The borrower is going to have to certify that the documents submitted are true, accurate, and correct. There's going to be no forgiveness without any documentation. And the lender has 60 days in which to make a decision. Now, this is interesting. Originally, there was no provision made for dealing with an appeal. And there's now been a suggestion and guidance which the SBA provided that there will be some appeal process, and further guidance on that is coming. So we have to await this guidance to see the conditions under which borrowers may be eligible to appeal decisions and to whom those appeals are made. We don't have those details yet, but the SBA has said, stay tuned, it's coming. Two last points. The application for forgiveness, following up on provisions contained in a lot of guidance, makes it clear that of the total amount spent, no more than 25% of the spend can be on non-payroll expenses. So that means that at least 75% of your total spend has to be on payroll. If you spend more than 25% on non-payroll, not all of your spending is going to be forgiven. You're going to have a partial forgiveness, and you'll be limited to 25% of your spending to the non-payroll expense. The SBA has been authorized to purchase these loans from the banks at what the banks expect the borrowers to demonstrate as eligible for forgiveness. So these loans can be sold to the SBA before forgiveness is requested and before the banks even know how much of the loan is going to be eligible for forgiveness. The banks merely need to provide an expected forgiveness amount, and that may not bear any relation to what was actually spent or the amount forgiven. Imagine a situation where a bank sells a loan for 100 cents on the dollar and is paid the full amount of the loan, but in the process of dealing with its borrower determines only 80% of the loan is forgiven. So does that mean that the bank is paid 120% of the amount of the loan? Technically, that's possible. I'm hopeful that this appeal process that the SBA will tell us about will be out there to deal with this potential in the conflict between the lender and the borrower and provide borrowers with some relief to deal with those points. But if not, the borrower's only resort is going to be to litigation. I get to take a quick breath. Dana, I'm sure you've got one or two interesting questions that have come up in the past hour.
We've got more than one or two.
Well, let's see how many questions we have time for. Why don't you start?
Okay. We received PPP funds on May 4th. We had already paid our May rent since it was due on May 1st. Will we lose this rent payment for loan forgiveness?
So we paid May 1st rent, and the loan funded on May 4th. So under the recent guidance, where SBA was allowing utility payments to carry across periods, because the rent you paid on May 1st applied to May, that was clearly an expense that was incurred in May. You should get, at worst, all but 3 days of that rent payment as being an eligible expenditure.
My loan funded on May 13th, so I don't have 8 weeks for payroll. Should I give everyone extra to use the money up in the 6 weeks I have until June 30th?
Well, from guidance that we've gotten from the SBA, we now know you get 8 weeks, regardless of whether the 8-week period, or at least I don't want to overstate the point. In that one particular example, the SBA showed a covered period for payroll going beyond June 30. So assuming the SBA means what it said in that example, you should be able to get the full 8-week period, even though it goes beyond June 30. So you don't have to pay them extra between now and then.
What if you do not hit the threshold of using 75% of the loan amount for payroll expenses? Would you be forgiven for that amount that is used for payroll expenses with the balance of the loan amount having to be repaid?
So that's a good question. The 75-25 test is not applied to the total amount of the loan. It's applied to what you spend. So if you have a loan of $100 and you spend it all, so long as $75 was on payroll expense and $25 was on non-payroll expense, you're fine. If you don't spend the entire loan amount, but you spend $50, in order to get forgiveness, you have to spend $37.50 on payroll and $12.50 on non-payroll. Now, if your non-payroll is over $12.50, you're going to be limited to $12.50, or whatever 25% of your total expenditure has to be. So the 75-25 looks to the total amount that you spent, which could be less than your full loan amount, and then says of that total, only 25% can be non-payroll. And if you spent more than 25% on non-payroll, that additional expense is not going to be forgiven. You have to repay it, and you'll get forgiveness on everything else.
Will staff on disability and workers' comp be excluded from FTE and salary calculations?
They should be, because technically they're not unemployed. They're receiving compensation under another program. So we should be okay if you have employees in those categories.
How many part-time employees equal 1 FTE?
Well, under one test, under one method of calculation, the SBA tells us that each part-timer counts as half an FTE. So 2 part-timers would equal 1 FTE if we follow the alternate test where each full-timer is 1 FTE and each part-timer is half an FTE. The other test requires you to divide the number of hours an employee works by 40 and then round to the nearest tenth, and you're capped at 1. So, if you use that test, the part-timers can result in a lower number of FTEs because we're looking at the actual number of hours they worked. But the 0.5 for each part-timer is an easy way to make the determination. And under that method, 2 part-timers equals 1 FTE.
How are employees on maternity leave handled in the calculations?
If I'm paying them salary, they're still considered employed, so they're part of my FTE count. And if I'm paying them the same if I'm paying them at least 75% of what they made in the first quarter, I satisfy the salary test and they look like any other employee.
Does a salaried employee automatically count as an FTE, even if they only work 25 to 30 hours a week?
No, it's going to be based on the number of hours they work.
What if an employee quits or there is a termination? Are there exceptions of a reduction in headcount? And if not, how long do we have to rehire to cover the reduction?
So there's two different things going on here. An employee who quits, who voluntarily leaves, the SBA says we don't have to consider them in any test. So if they resign, they've made our lives easy. We don't have to include them in any of the analysis. If you fire them for cause, they did something wrong, they didn't follow company policy, you also don't have to consider them in the analysis either. So those reductions in force are excused. Any other reduction, you have until June 30 to correct.
If an employee worked the full first quarter but took a voluntary leave of absence for a portion of the 8-week period, if their hourly pay rate is the same, will the payroll reduction math apply?
If they voluntarily reduce their hours or voluntarily took leave, we don't have to test them.
For the payroll reduction rule, does the employees have to work the entire calendar quarter prior to loan origination or just a portion of the quarter?
Just a portion of the quarter. And we're going to average over the entire quarter. So if an employee worked 2 out of 13 weeks, their average compensation is going to be based on, 2 divided by 13. The weekly rate's obviously going to be a lot lower. It's going to be easier to test for them. How about one more, Dana?
Sure. Does average pay for an employee in the first quarter need to include the overtime they were paid?
I think it does. I think there's some disagreement on whether it should only include regular compensation, but everything that we've seen talks about compensation without any sort of qualifier. The overtime affects some employers. The bonuses paid in the first quarter relating to the prior calendar year affect some employers. The ability to only have to pay them 75% of that amount in the covered period should sort out a lot of the overtime and bonus situations, but pay is pay for purposes of making these determinations. This last slide that I have up obviously has my contact information. A good many of you have sent emails or called with some questions. It's difficult for me to respond to telephone calls because I get so many over the course of the day. Probably easier if you have a question to send them by email. And we've answered literally hundreds of emails over the past 4 weeks. I do the best I can to answer a question or two for people. We're also available to work with individual borrowers answering your questions, either through a one-time consultation, or you can hire us and we'll work with you for resolution of all of your questions, whether it's reviewing your application for forgiveness, or if you have other questions as well. As I pointed out in the beginning of the program, we are working on a webinar that is tailored just to the forgiveness application itself, and we hope to roll that out in the next 10 days or so. We continue to send out email blasts on important guidance changes coming from the SBA, so continue to look for that. And I guess we have another program that we're going to schedule for next week, and possibly the week after will be our program on the forgiveness application. Thank you again for your time and your attention this morning. Have a great day and be safe.